The problem with optimism bias is that people feel generally fine if their circumstances feel comfortable. Many may even feel genuinely positive about the future, confident that the foreseeable future will be much like the recent past. This isn't a question of people being utterly oblivious, although that's a concern too. Being generally optimistic is just a part of human nature. Reality is based on socioeconomic theory. Specifically, it's often society's mood that drives events, not events that drive the mood. So think of this as a sort of reverse jujitsu to what most people intuitively expect. Most people think in terms of the economy or the stock market is crashing, so we need to worry. What if instead people began to worry, and as a result of that, the economy or the stock market crashed? It's the same fact pattern, but the cause and effect are reversed. The possibility of that outcome creates a need for economic thought leaders of the day to routinely suggest the economic glass is always at least half full. So if you ask most people in the first quarter of 2026 what their gut feeling is about the economy or the stock market, you'd find that most people are fundamentally optimistic despite mounting structural problems. Collective social psychology demands reassurance, not warnings. I wrote about why this is dangerous in my 2023 book, Bullshift: How Optimism Bias Threatens Your Finances. For the past number of years, I've been using American data to ring the alarm bells, but this time I'd like to draw some attention to Canadian data. As of February 2026, Canada's private debt level exceeds that of Japan in 1991 and that of the United States in 2008. Housing in Canada is valued at 12.5 times income, even though it's historically been available at 3 to 4 times income. There are $320 billion in mortgages being renewed in 2026, and renewal rates will almost certainly be higher than they are currently. Meanwhile, the fertility challenges and demographic bombs I've spoken about in general certainly apply to Canada in particular. Canada's fertility rate is currently about 1.25 children for every female. The prevailing societal mood isn't rational, it's herding behavior. Since interest rates peaked in the early 1980s, we've had over 4 decades where people have known nothing other than central banks cutting rates and real estate prices rising as a result, until 2022. I would call it recency bias if it wasn't so entrenched and long-lasting. The simple fact is that most Canadian adults have never known anything other than relatively good times economically. Optimism in this environment is not a sign of rational thought, but rather a sign of irrational conformity, a firm belief that the past is prologue. Many people have tried to portray me as being a bear when it comes to capital market expectations, and I find that ironic since I would self-identify as being a realist. My concern is that virtually everyone seems to be overly accepting as an optimist. Many commentators and analysts are ignoring the evidence that's staring them right in the face. The commercial imperatives of always buying and never selling and staying the course and taking a long-term view are all well-established industry mantras that do more to protect corporate interests than they do to offer a meaningful, clear-eyed perspective to retail investors who just want good advice. As I mentioned in the book, governments are only too happy to play along. Consider the role of central bankers. Governing parties in both Washington and Ottawa want low interest rates as much as Wall Street and Bay Street do. Like government politicians, central bankers are mostly just good mood managers. The collective experience of 2020 and 2021 was a telling experiment in monetary policy being used as a lever in dealing with the health crisis. But in that respect, COVID-19 was great for governments and financial advisors because it led to virtually all asset classes being hyperinflated through artificially low interest rates that were justified by the health scare. By the time we got to 2022, and inflation was frighteningly out of control, rates had to be drastically increased, and stocks and bonds both saw double-digit declines as a result. Now, it may very well be that the prescriptions for deleveraging in 2026 may turn out to be more draconian than used in 2022. What then? Here's a paradox that recently came to my attention. In a credit-based economy, confidence is key. And as a result, people with the most information, like central bankers or chief economists or industry analysts and ministers of finance, are often the least able to offer a proper warning. A simple, clear, unequivocal pumping of the attitudinal brakes could manufacture the outcome that they desperately want to avoid. This is the worst kind of self-fulfilling prophecy. The people we rely on to give us a heads up are systematically constrained and unable to do so in a meaningful way. If your dominant narrative and base case worldview are rooted in the idea of everything being more or less fine because nothing has really gone wrong in your adult lifetime, you're taking a massive risk. The past may not be prologue, and having an optimistic outlook may cloud your ability to see things as they really are.